The Gort Show is sponsored by Ellipsis Labs. Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. You may know of Ellipsis Labs by their first product, Phoenix, a fully on-chain order book DEX that's done over $50 billion in unincentivized volume. This is one of the strongest teams I know in crypto. If you're interested in working for a mission-driven company, Ellipsis Labs is hiring engineers who are passionate about crypto and finance to work on Atlas. You can learn more and apply on Ellipsis Labs Twitter, @ellipsis_labs. Don't forget to check out Atlas too, @AtlasXYZ on Twitter. Hey guys, today we have Felipe from Theia Research, and it's a liquid fund in the space. I'm going to let him explain their thesis, and then sort of we'll talk about what like the context was for this conversation. But yeah, welcome, Felipe. Yeah, just give a little bit of background and then what you do.
Yeah, absolutely. Thanks for having me on. So I'm the CIO at Theia. We're a liquid fund in the space, started about 3 years ago, focused fully on fundamentals. So my background and the background of my co-founder are both in mid-market private equity, where we'd be buying traditional companies in healthcare, industrials, financial services, but really valuing things based on kind of existing and future cash flows and selling them to a market that was predominantly priced in those terms. I think we both got really comfortable with that valuation framework and have tried to apply it to apps, applications and liquid tokens, and have found that it's been a good way to invest over the past 3 years. Most private equity kind of strategies have the same elements. It's basically invest in fundamentals, build models, gain conviction around a small number of theses or themes that you want to invest behind, and then work really hard with teams to try to see the KPI growth you want in the world. And your returns come not from narratives, not from selling to somebody who believes your story, but from actually seeing the thesis play out over 2 to 4 years and kind of having price growth track KPI growth.
Yeah, awesome. Okay, so yeah, a little bit. There's like some context for this conversation, which was that I wrote this long word cell drivel post on Twitter about basically my view of crypto, at least up to this point, and this is kind of getting into what we're going to talk about today, has been that I find it hard to look at a lot of this stuff and come to what one would consider fundamental valuations. And most of my thesis, which is very unsophisticated and it could just point to my own naivete, is that we're just kind of early. And so when we're so early, it's very hard to look at these things from fundamental perspective or cash flows or whatever it may be. And then you kind of responded and made a point which I think we both agree on firmly, which is, if you had to choose between owning like all of Coinbase or all of WIF, it's pretty obvious that, you would choose to own all of Coinbase for its cash flows. So to that end, like we're going to kind of get into, so actually one other part was I kind of said, okay, how about you come on and talk about, half a dozen coins or something. And then I'll take either the other side, or we can just discuss them and try to understand like why you made the investment that you did. So I guess before that, like just maybe a little bit more context. When you say, like fundamentals, just maybe give us some idea of what that is in your mind, like maybe specific metrics or just, the fund thesis more specifically.
Yeah, and it comes down to what you mentioned, which is the Coinbase versus WIF test. And just to like tell it to the audience, would you buy all of Coinbase for $100 million? And the answer to that is obviously yes. They made $5 billion of revenue last year. Unless you think the business is going away tomorrow, you're going to get paid back on your capital pretty fast, and then make a big multiple just on cash flows, even if you can never ever sell that equity to anybody else. If I ask you the same question for WIF, the answer is obviously no, because WIF will never make $1 of cash flows. So even if you could get it at 1% of the valuation, you still wouldn't put material capital into that, because the entire value of WIF is premised on selling it to somebody else. This is like an old TradFi test, which is like investing versus greater fool trading. And most of our industry has been in the greater fool paradigm since the beginning. And I'd say 90% plus of assets by number still trade in that paradigm. I think what we are focused on is the sub 10% that don't, because even though it's not the majority of the assets, it's still enough to invest in and make good returns in. So we're focused on assets where the future cash flows of the asset will pay back your purchase price plus your cost of capital. So nobody, market shuts down, nobody believes your story. You still make a return if you're right on your prediction. And that, that's the framework for fundamentals. And it gets to the answer of like, what is the core KPI? The core KPI is free cash flow to token. Everything else is only a KPI insofar as it instructs you about future free cash flows to token.
Yeah. Okay. So I wanted to ask, it seems somewhat implicit in your overall thesis that the market is moving toward investing in fundamentals, whereas in the past that may not have been the case. It seems like what you're saying is we're moving to a spot in this industry. It's growing, it's maturing, where now people will start to look at fundamentals. Do you so first of all, would you agree with that? And also, was there like any chasm crossed in your mind that makes you believe that, right? Because I guess, just not to be too long-winded here, but my thought, and especially this kind of goes to my post, was like, look, you can have this, well thought through, well modeled fundamental thesis, but if the market doesn't trade on fundamentals, then no one's going to care. No one's going to buy your bags at, the 10x multiple that you think it should be worth or whatever. So do you think that one, would you generally agree that that's your thesis? And then two, is there something about, the recent, kind of paradigm shift that makes you think we're moving toward that?
Yeah. So there are two actually big questions. So I'll separate them both. I think the first one's easier. I do think the market's moving to fundamentals. I think that, I've seen it firsthand. One, because LP capital wants to move towards fundamental strategies because they get it and they can sell it to ICs better. And in the past, in 21, there really weren't many tokens with fundamentals at all. When we started, our universe was five tokens and 3 were overvalued. So it was really, it was really early then. Now you're looking at like 50 high quality names with proper fundamentals that trade within range every now and then. So now that it's there, it's just LP preference skews towards fundamentals because all of the people with capital and TradFi grew up in a fundamentals based economy, and it makes sense on first principles to them. And then add to that most liquid funds that have been minted over the past 3 years have managers that come from TradFi. So either they, even if they don't trade fundamentals today, they respect the thesis and they'll be happy to move there if they found it to be compelling enough or interesting enough for them. So I think we kind of have, more tokens with fundamentals, more revenue across the sector. LP capital wants it. New managers want it. So we're definitely moving there. And I think there have been two points over the past year that have really pushed that forward. Before March of last year, everybody was waiting for the bubble to return. So there was this idea of we're kind of in wait mode. There will be this manic super bubble where every asset will go up, 20 to 100x, regardless of quality. It doesn't matter. All you need to do is be in names that could catch a narrative during that period. During March, I don't know if you remember so well, everybody thought we were entering that period, and a lot of assets with no value traded up in anticipation of kind of the future manic bubble buy pressure. But that move was like firmly rejected. People lost a lot of money from March to May on names that they bought in anticipation of a manic super bubble. And the same thing happened again in December of this year, where people buying AI agents, buying all these things that don't have value but seem like good narrative at the time. And every time somebody gets burned on trying to trade a manic super bubble, they are more likely to switch to a safer way of investing, which is fundamentals, or their LPs are more likely to move capital to people who have that mentality. So I think there's a lot of things moving in that direction. Those two kind of traumatic experiences for people moving in that direction. And it's just as there's more revenue in the sector, it's just the natural way for things to go, right? I do want to answer your second question, which is like the kind of the heart of the topic, which you said, does it matter if you buy something with good fundamentals if nobody believes your story? And that's like it's the most nuanced point. I think it's the number one sticking point when talking about this thesis. I think the answer is it doesn't matter if no one believes your story, if you are long-term capital, because and here I need a better name for this, but we kind of talk about fundamentals and fundamentals narrative, and like fundamentals narrative is not a good name; it's confusing. But are you talking about numbers to tell a story so somebody buys your investment? Or are you talking about numbers because, again, you believe that the cash flows will actually pay your investment plus cost of capital, right? So fundamentals narrative will be people talking about like TVL multiples, saying, hey, these 4 things trade at 7 times TVL. My bags trade at 1 times. You should buy them, right? There's no link between that TVL number and like actually getting your money back.
Yeah, exactly. It doesn't mean like that's, I think that's, just to interject, like that's one of maybe my bigger contentions too is something being relatively undervalued means nothing with regards to its fundamentals. And like, I think this is, kind of going to my, maybe taking slightly the other side of a lot of this. I mean, that is how I view this a lot of times. Like, oh, well, this is, it has similar, revenue or cash flows and it's trading at 1/10 of XYZ protocol. It's like, well, maybe they're both overvalued by 100x. Like it means nothing, right? So go on. You could go ahead and finish.
No, that's what you see most of the time. Like people who are we won't get into like L1s and L2s, but you see a lot of that type of valuation in L2s where, they're trading at average multiple is 250 times and one is trading at 100 times. Is it cheap? It's not cheap unless you get your money back plus a cost of capital. And cost of capital in the industry, we can get into that, is steep. So actual fundamentals is saying, hey, look at this model. I'm going to make my money back whether you believe me or not. And just to give one example that I cite frequently, we've had 5 investments as of last month where we got our full purchase price back in dividends. So one that I often talk about is Banana Gun. That paid back, last year in 9 months, paid back our full purchase price. You can't argue with me that it's not fundamentals because I got my money back, right? And presumably I need to get my money back plus the cost of capital. Again, we get into that nuance, but it doesn't matter whether the market believes me or not on that name. It just matters that we're right.
Quick question on Banana. When you say dividends, you mean like actual free cash flow, right? Or do you mean buybacks?
I mean actual free cash flow.
Okay, yeah.
Thanks for listening to The Gwart Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
Let's go ahead and move into sort of understanding a token valuation. What are you looking at when you're looking at tokens? What models are you using? What metrics stand out to you? You and I have talked about like quality of revenue is like a very, very big variable in this industry, right? When you have like so many reasons for tokens to pump or whatever, and looking at a revenue in a snapshot of time may mean nothing in the long run. So what are some of these metrics? And then also, like you've talked about DCFs a lot, right? This is like a very, traditional and widely accepted valuation model. I'm curious also, sorry, I keep asking 2 questions at once, but how well do you think this, maps? And are there reasons ever that these assets don't map well to some of these like fundamental valuation methods?
So again, a couple answers there. First on metrics. So, I mean, we look at a couple metrics. One is on market cap. I think it's important to think about that because it's kind of the numerator. We look at adjusted market cap. So people just debate a lot between circulating market cap and fully diluted market cap. We think on first principles, obviously circulating is wrong because if you have a big unlock coming, you need to factor that in, right? Or, a common set example is like Celestia. Early last year, you couldn't really look at circulating because there are big unlocks coming during the year. And you also need to consider who, Aerodrome's a great company. They have circulating market cap, which is what's floating, right? But then there you have to look at who's getting the revenue from the call. So if a locked up cap token is getting revenue, that definitely counts as part of your numerator because there are people who are sharing the economics with you, right? So that's why circulating doesn't make sense. I think we all kind of agree with that. Fully diluted doesn't make sense because oftentimes the company has no plans to use that treasury, right? I'll give you one example. Like in traditional markets, if Apple wants to raise equity and like build a new factory, they just issue equity, right? And they mint equity, get cash, build a factory. In crypto, a lot of companies just have that on their balance sheet in case they ever need it in the future. But there's no predictable reason why they would need it. A good example of that is Radium, where half their tokens are in treasury. They're making $200 million of cash a year. They haven't touched those tokens in years. They're not allocated to anybody. It's just on the treasury. That to us does not count as doesn't factor into the number.
But would you map that, like, let's say we're doing something like earnings per share. Would you map those 50%, Radium treasury, like in traditional finance for a second? Would you say earnings per share would be half or the full 1x,
You would say we would not count the treasury shares on balance sheet because we don't think they will be, but here's a key component, because we don't think they will be floating within the next 3 years. So we build a model on token issuance as well. Not only on earnings, but also what do we think they will issue over the next 3 years? A good example was like CowSwap had tokens on treasury, but we thought, given their cash situation and their team size, that they would issue 30% of their treasury in sales over the next 3 years. So we counted that, right? So it's models everywhere, but this whole industry, the whole discipline of investing is about predicting. So you try to predict how many tokens will be outstanding 3 years forward. 3 years is an arbitrary number. You could say 2, you could say 4. It's a question of how part of the market will look. But we use 3 years forward, and then we multiply that by price to get adjusted market cap. That's long. There's a lot more metrics. Any question on that though first?
Well, is the reason for that, is that typically your holding time just for the audience?
We do 2 to 4. So 3 is right in the middle. Exactly.
Okay. Yeah, that makes sense. No, I don't have too many questions on that. I'll be honest, obviously it's on a case by case basis, and it's on an application and I'm not as in the weeds as you, right? Obviously, so I mean, this is your job, it's not my job. Sometimes that seems intuitive, sometimes it doesn't, and the history of crypto is absurd shit happening. So I understand. I think what you're saying seems rational, but then I see 50% of Radium tokens, on the treasury. If you're looking at a 3-year, forward, that seems intuitive to, kind of put those aside. If I'm looking at holding this for 20 years, I'm sitting here and I'm saying, all right, defensible moat, recurring revenue. Do I really want to assume that half of the float is just, effectively burned? I don't know. So it does. I do think timeframes matter, and I don't invest like you do, right? So it's just a different mindset, really.
No, but you're right, and I think that the 3 years is a debatable point, and maybe you should be looking at if we really thought nobody would value fundamentals and we had to just hold it for 10 years to get the money back, we look at 10-year forward, right? There is some judgment there in where you apply the year. So I completely agree with you. Oh, completely. And all of these decisions are nuanced, judgment based. You're just trying to think of first principles and trying to do your best with the metrics. So another case of that is we actually use price to sales a lot, which is definitely an imperfect metric. Most of TradFi does EV, EBITDA, enterprise value to EBITDA in private equity. Someone like Buffett, who's more of a purist, would use EV to operating earnings, which removes depreciation, because that's a signal for CapEx. We actually just go full on revenue. And the reason we do that is because so many of these companies are so young and so scalable. The one thing, there's a lot of negatives which we'll get into in the industry about moats and defensibility. But one thing that our protocols really have is scalability, right? Camino has 20 employees and $3 billion. Radium did 500 billion in volume with 10 people. These are numbers that are just unheard of. So thinking about revenue makes more sense, because if you have, this example we use is you have 2 companies with 10 million of revenue. One has, you have one company with 10 million of revenue and 5 million of costs. They have 5 million of profit. Another one has 5 million of revenue, 5 million of cost. It has 0 profit, right? But you should really think of those companies as 2 to 1, because if they both scale 10x, they're going to converge on the 2 to 1, not on 10, infinity, basically.
Yeah. And so, okay, I'll start, again, playing devil's advocate here. This is something that I think is alluring about a lot of these companies and projects and protocols is that oftentimes CapEx can be really low, right? Like sometimes, almost, converging on zero. And then, well, like you said, you can have a company doing 200 million in revenue with 5 or 10 employees. We go back to DeFi summer, we see projects, at least at the time, doing 500 million in revenue with 2 coders in their parents' basements, right? So like that is one side of this that I think you're spot on about. Like because software scales sort of exponentially, at least at the beginning, that's alluring as an investment. The other side, right? Like, and this kind of goes back to my original post, is this can also be, just as much of a pitfall, in the sense that, like, because these systems are permissionless to access, permissionless to build on, the barriers to entry are, some order of magnitude lower. It means that the defensibility of moats becomes very cumbersome. And that, like, so in as we move on to kind of talking about tokens, I think, we agree, like, sort of segmenting this to like application layer right now. We both agree that you can build an application on an open source protocol and make money. And you can charge something that appears to be, a premium, however you want to define that, for a good user experience, liquidity, security, whatever it may be. Like, I'm not going to like deny that, right? I think my overarching, view is that it's hard for me, as somebody who's not really in the weeds, to look at these and say, like, okay, this has a defensible moat versus XYZ. And the reason is it's nothing very scientific. I've observed, 3-4 cycles of crypto, and mostly what I see is tokens, hit some market cap that's very high in US dollars, and then they sort of trend down, over these cycles. So that's really, and so maybe you can dig into that a bit, like what, moats, defensibility of moats, like the differences maybe from coming from private equity and now investing in projects that are, the barriers to entry are lower, or some parts are open source, whatever it may be.
Yeah. So I fully agree with you. We wrote a piece on moats in response to a thread that you did on this exact topic weeks ago. And the reason we like put a lot of energy into that is because you're asking the heart of the question, right? Like, fundamentals matter. It's not debatable because you get your cash back. I feel really strong about that. Like, it's going to be hard to convince me otherwise. Moats are the critical assumption to this working in the long term. And I believe there are some strong moats in the industry, but I think it's a good question to ask, and one we can really debate. And there are going to be compelling points on both sides. But what I'll start by saying is, it's a little bit like, we definitely agree that 90% of companies don't have moats in the industry. It's a little bit like saying 90% of companies are overvalued. So, like, put that aside. What I would argue is that there are some companies, some tokens with moats, enough to invest in, basically. And one piece of evidence for that would be one of the moat tests you use in traditional investing is called the market share test. And basically, you look at market share over a number of years, and if the leader has constant market share over a number of years, that's usually a pretty good sign that there's a moat, whether you know what it is or not. And you do see that in a lot of parts of the space. Like, you see it in EVM trading with Uniswap on mainnet. You see it on, lending with AAVE. Like, the AAVE team, like the founder left to start a new protocol, and AAVE kept 70% market share over 4 years. That's a pretty good sign that there's a moat there, right? You're kind of seeing the same thing develop on SVM with Radium and Camino. So, you have that kind of hint. And, on moats, I do agree with your point on open source software. I think that more and more of the software world will look like open source, just because these AI platforms are making it so easy to replicate code. So it's good to think about, like, how do moats exist in the absence of closed source software? And there are some moats that have worked really well, and most of them are related to, like, to some extent, where being better or having a larger brand gives you better, a better product. That's kind of the first principles heart of it. So, examples of that in the industry, like network effects, we all know easily, we all know pretty well. Like, more users gives you a better product. That's TikTok, that's Twitter. We all know that. But it's also every auction, right? Hyperliquid has better liquidity because it has more users. More users lead to more market makers. More market makers lead to better liquidity and more users, and it's kind of that virtuous circle that every company wants to achieve. Same thing with Binance, Coinbase. LSTs have the same thing, where the more liquid Jito Sol is, the more likely you are to integrate it, the more likely you are to buy Jito Sol as opposed to another type, another LST in the industry. So both of those are like Circle USDC is the same thing, USDT is the same thing. Why would you hold a less liquid stablecoin than the more liquid stablecoin, right? So it's like the bigger company is better positioned just because it's bigger, regardless of code. None of these have anything to do with forking the code. You can see the same thing on the cost side, where like some companies just by being bigger have lower costs. Again, traditional examples are like Walmart is so big it just negotiates down products, so it lowers prices because it's big. Or Amazon's so big it can invest a lot in logistics, so it's like next day delivery because it's big. And a small player could fork all their code, bring their people over, but it's just not big enough to have that kind of footprint. You see the same thing with players like Camino and AAVE, where they're so big that they have the most liquid pools on a per pool basis. So if you're a whale who wants to deposit $100 million, you have to go to AAVE because that's the only pool where you can actually take that amount of capital, like deposit that amount of capital, and not be worried about getting locked up if a couple borrowers leave. So again, like independent of the code, just the size gives you the advantage, and that becomes a moat for the market leader. There's more that we can talk about, but I want to.
I think the liquidity aspect is undeniably true, right? Like liquidity is a moat. Mostly what I have observed is that I can say that and agree with that and still not necessarily know what to do with that information. And in fact, I would point to AAVE as being, I know we're going to talk about Camino, but we could just for a second say, talk about AAVE. Like I think AAVE is trading around, I don't know, $2.5 billion right now. And it is making, like net, again, this is where we've bastardized these terms in some ways, like revenue and fees, like fees, right? Go encompass like LPs and stuff. So like we're looking at, bottom line here, revenue, they're making like 150 million roughly a year. Now, like if you want to take the view that, we're converging on more and more efficient markets as we disintermediate, TradFi, like that's great. They're not making much. As an AAVE holder, I'm not necessarily looking at this and saying like, wow, this is deeply, deeply undervalued. It may be, but I don't know that. Like on a price to sales, what is this, like at 35 or something? It's not like, go ahead.
No, go ahead. Make the point.
Yeah. So I don't know. I mean, I guess my main point was like, okay, liquidity can be a moat, and I don't know that means it's, a stellar investment, right? So that was just on like the liquidity aspect, because I do agree that's certainly a moat, right? Like, but in terms of the money you get out, it's not always that compelling.
So I think, getting into specific names, the point I'll try to make is that there, over the past year, some of these names were undervalued for a period of time. I can't vouch for like the current price at all times, basically, or like the day this comes out. But talking about AAVE, two points to respond to what you said. One, on fees, just going back to the metrics question, like price to fees makes absolutely no sense at all. Yeah. Because fees have such different levels of revenue flow through that it's just not a comparable metric on any kind of world. Like if you're doing fees on stable swaps, you're making 1 BIP. If you're doing fees on front end volume for meme coin trading, you're making 100 bips. Like you just
at least.
At least. You just shouldn't use those metrics. So to take out fees completely. But yeah, on revenues making 150, market caps like 3 billion today unadjusted. So like 20 times price to sales. It was at closer to 1.5 billion a few months ago. So kind of 10 times price to sales. And I think the point you can make with AAVE, the what you need to believe model, that would have been credible there, would have been, look, they have a moat, they've maintained 70% market share. You have this, pretty strong liquidity network effect, liquidity economy of scale that we talked about, where it's, cost of capital is cheaper. You also have a nice like IBM brand moat, which is, there's this old saying, nobody gets fired for hiring IBM in the corporate world. Yeah. And there's some of that with AAVE, where like if you run a fund and AAVE gets hacked, you will look much less stupid for losing money that way then if you run a fund, you put it in like lending protocol number 5, it gets hacked, and you're the only guy going to your LPs saying, hey, we lost money this way, right? There's a lot. If you feel and are a lot safer depositing on AAVE, and it also is safer because it's never been hacked. Has that what people talk about Lindy. I call it brand. Like it just has a lower cost of capital because of the brand too. Would you move money from AAVE to the 5th largest lending protocol for an additional 2% yield? Probably not, right? Because the risk is you are losing all of your capital. Maybe a degen would, but a fund wouldn't. Like you need a lot more than 2% to take on the incremental perceived risk.
Yeah.
Some moats there. Definitely some risks. I think, one of the big risks is like modular lending market share. Morpho has taken a lot of share. They're at 10% over a few months. I think there are incremental players like Euler who are really strong. And modular markets just make sense. We can get into that as well. So AAVE hasn't moved fast enough in that dimension. So they can be disrupted through new players that are kind of competing on design space. And I think something that you've talked about before, like they can get disrupted by JP Morgan, right? Like JP Morgan decides to come in, they fork AAVE. All of a sudden their liquidity network effect is not 30 billion, but 300 billion. And that's the winner, right? And the brand is better. All those things are better.
Yeah, I this is one thing that, I just probably have such polar opposite views with a lot of the crypto community on with regards to like, sort of this regulatory clarity thing. Like I'm not convinced this is, going to be some massive boon to current crypto players, right? Like it's not at all intuitive to me that like everything is, put into some type of regulatory framework, and then now AAVE and JP Morgan are on the same footing. And if JP Morgan sees opportunity there, they can fork the code. I mean, AAVE did it all the work for them. And I'm not trying to be like, too cynical, but that is another, that was like one of my like sort of base reservations about, making fundamental investments right now on the grounds that look like regulatory clarity may be great for expanding the reach of this industry and growing it the way that we see, but on the other hand, like now Goldman can come in, now JP Morgan can come in. And so, yeah, that's also to me, I don't know. It's interesting because a lot of this stuff is open source, because it's, again, barrier to entry is very low. Oftentimes there's not like high CapEx to kind of enter the space. Well, these big institutions can come in and just, provide really the same thing with much greater network effects.
Hey, this is Will with Blockspace Media. And I don't know if you heard, but we just announced the second edition of our conference series, Op Next, now to be held at the MicroStrategy HQ in Tysons, Virginia.
That's right. After the success of our first scaling conference at Fidelity last fall, we're doing it again this spring, April 11th and 12th at the MicroStrategy HQ. I'm really excited for the programming. We have various stakeholders, industry, developers, and Bitcoin miners present.
So join us in April for open, neutral, and honest conversation about the leading proposals and technical solutions that will scale Bitcoin to the next billion users. No booths, no tokens, no shills, just Bitcoin and honest conversation.
You can find tickets and more information at opnext.dev or click below in the show notes.
I wanted to ask, okay, so we are going to talk about some tokens, but I wanted to ask one last question just to understand your kind of position. How do you feel about, I don't know if this is exactly the right word, but like property rights or shareholder, rights when you go in and buy a token? This is the last kind of piece that I've talked about before. How do you know, like when you go and buy some decentralized protocol that hopefully the founders are doxed to at least you or something, how do you know these guys aren't just going to even in ostensibly legally just give themselves to treasury, right? Like that's one thing that I'm also curious, as coming from private equity where you are signing like real documents that are legally enforceable in US courts. How do you kind of view that, and like what risk premium do you put on that like sort of idea?
Yeah. So let's talk about that. There's a few points there. Quickly to AAVE, I'll say this a few times in the conversation, but like what we're discussing here on underwriting AAVE and thinking about it, that's what we should all be doing on Twitter, is my view. right? Instead of like manufacturing narratives, we should be talking about disruption risk, go forward revenue, moats. Like if we all spent our energy doing that instead of trying to get each other to buy narratives, we would be, it's like the meme of like the futuristic city, as
I know, right? The world if.
World if, exactly. So I'll say that a few times. Like our whole goal with this fundamentals like push is just get the discussion at this level, and then you can disagree with me on all the tokens, think they're still all overvalued. But what matters is like we're discussing the actual model and prediction for the future. Shareholder rights, look, it's a big problem, right? It's a big problem for investors in the space. It's not a problem. It's just like it is a fact of life that you have to deal with. The only way to solve that is one, to be smart about it. So like we look for one, we don't invest in founders who aren't fully doxed to us and the broader community. Like we'll maybe if someone's Twitter anon, that's fine, but it has to be somebody that people know and like know on a first name basis and have met and meet at conferences that we see on camera once a week, right? Two, we look a lot at incentives and lockups. So going back to Banana Gun is a good example. The team there is locked up for 8 years, and they only make money based on cash flows going to token. So their locked up tokens get cash, but they can't sell for 8 years. That's a good situation because they have the right incentives there to try to build. Our incentives are aligned. We both want them to build revenue to token over a long period of time. If the team is fully unlocked, that's not as good. If the team is selling, it's definitely not as good. And then the worst case, which I kind of go on about all the time, is if the team has equity. So like this is the Uniswap case. Yeah. Uniswap's an amazing company, but like the Uniswap token, Uniswap Labs equity case is untenable and is like the most flagrant example of what you want to avoid in the industry because all of the value goes to the equity component, right? And we talk about like the backyard test. Given the current incentive structure, if the team found $1 billion in the backyard, who would they give it to? And sometimes the answer is themselves, and like we can't invest in that. Sometimes the answer is the equity component, which is like what happened with Uniswap Labs when they put on a 25 basis point fee to the front end, and just give it to the front to the labs entity. And sometimes the answer is like, look, given the incentives, we're pretty sure they'd give it to the token because of how lockups, ownership, incentives, reputation, also motivations of the founders. Like, do people, you can kind of tell what people are in it for pretty quickly after you've been here for a while. And that factors a lot into the decision. But all these things are just kind of judgment bases to reduce the probability that you get rugged by the team on the token, right? And it's going to happen if you're in the industry long enough, where the team will find value and not give it to the token holders. So the only way to solve the residual there is through cost of capital, which is why when we talk about things, we'll talk about AAVE in this light or other investments, like you have to be delivering a pretty good return, underwriting a pretty good return to deploy capital into tokens at all. So like PE funds, they make 20% by buying tire companies with like pretty reasonable leverage. And like they're going to keep doing that. And you can debate whether it'll be 15% going forward or the same 20%, but like they're hitting those numbers with extremely low risk compared to what we're doing in token investing. And it's like a proven asset class, it's known. So you have to be hitting a pretty big spread over 20% for investors to reasonably want to give you money. You can always sell investors, but for it to be a good decision, you have to be hitting a lot higher than 20%. We think token cost of capital with the current legal setup is closer to 50%. So you have to be underwriting to those returns to want to deploy at this, given all the kind of undiversifiable, unseparable factor risks, of which the shareholder rights is like one of the main ones.
Yeah. Can you just like, to put it in a little bit simpler terms, when you say, you have a 50% cost of capital, you make an investment, 3 years later, you sell it, your multiple that you think is, reasonable, given the risk is what, just for maybe like GAAP people.
Yeah. So 3.35 multiple on 3 years.
Yeah.
4 on 4 years, it explodes pretty fast.
Yeah.
You have to be making big multiples in 2 to 4 years. So like when we're doing 2 to 4 years, we're usually looking at, if something's not a 5x on a 4-year underwrite, it's not interesting to us.
Got it. Yeah, that makes sense. Okay, cool. All right. So now let's talk about some tokens. You guys are investors in Metaplaex. Give me the thesis.
Yeah, so Metaplaex is a good one. I kind of suspect what you're going to push back on already, but they're making $50 million of revenue. Market cap right now is $230 million. We invested a little while ago when it was about 100, but let's talk about right now because the price now is actually fine. It's trading at 4.6 times sales, right? They have 99% market share. For the audience, most people know what Metaplaex does, but every time you mint an NFT on Solana or every time you mint a token, you pay Metaplaex a fee. And that goes also for like deep in protocols like Helium. Whenever they're minting like hotspot, IP addresses, they're doing that on Metaplaex tokens. Like most things you could feasibly build in the SVM will use Metaplaex as the backend and pay Metaplaex fees based on activity. So it's a really good way for us to track SVM token activity, which is a metric that we like and feel really good about over the next 10 years. Because we are, long Solana ecosystem. I should mention this up front, we are really long the industry. Like we think activity in the industry will increase exponentially over the next 10 years. And SVM activity as one of those buckets, we also think will increase exponentially over the next 10 years. So you kind of have this 99% market share on SVM token activity like factor that you can capture with Metaplaex that we really want to capture. You have pretty good moats in our view. Like one, you have, Metaplaex is a library, like it's a code base that you use. Most code base and libraries have network effects because people are copying code, ChatGPT is recycling code to give you the answers. Like AI actually makes this network effect even stronger. So people just kind of use Metaplaex. You have this really good dynamic in Moats where the price of the product is really small relative to the price of the output. So like a Metaplaex fee is like 0.01 Sol.
Yeah.
It doesn't matter for your product. Like your product is making so much more money than that you're not going to try to add risk to your project to sub out Metaplaex for something that's 50% cheaper.
Wait, do pump.fun tokens?
Yeah.
Okay. All right.
We'll get into quality of revenue there.
Yeah. Okay. So like talk to me about what, and well, I wasn't really going to push back on. I mean, I don't know why meme coins would stop getting released. So that wasn't really what I was going to push back on. But yeah, like how do you view the quality of revenue with Metaplaex? They're doing, wait, hang on. I think I looked this up. So like, I don't know, 40 million a year in revenue. Is that right?
50 if you take the last 4 months.
Okay. So 50 million a year. Like what is your kind of, prognosis or like, what is your outlook there?
So that's a good question. Look, so much of this is like not just adding. I think it's going to grow over the next 4 years. How about that? That's like all I need to assume, basically. So we talk a lot about like what do you need to believe, right? And what you need to believe on Meta, you want to have the what you need to believe be as unheroic as possible. So if you're stretching in a what you need to believe model to be like they're going to grow revenue 1,000 times and they're going to keep they're going to beat the 1 and 2 players. That's like a harder investment to make than something like Metaplaex where it's like they're making 50 million a year. It's trading at 230 million. We think the 50 million will grow. We know the team is good. They're doing buybacks with revenue. That's kind of all you need to believe to make this a good investment if you are long the industry. So that's when we've been able to reduce the forecast to kind of the bare necessities of them not getting disrupted and meme coins or NFTs or Solana activity in general not going down 80% for a long period of time.
Yeah, that makes sense. And I don't necessarily disagree with that. Okay, so Metaplaex, though, uses the revenue to buy back the token.
Yeah.
How do you view this, like what in terms of the way you guys, sort of invest? How do you view token buybacks or, occasionally burns, whatever it may be, versus, or if there's a difference there, and then versus, just pure cash to holders, like, effectively a dividend? Like, how do you view those differently?
So,
because I do have one thought on that, but like I have had some reservations. That's why I say that, but go ahead.
Yeah. So the way we see, I think first principles, it's all about capital allocation. So like in theory, if you had proper legal protections and you trust a team and the team is able to invest in high growth, high return projects, they should be keeping the funds and investing in it, right? Now that's like the theoretical answer. If the team thinks the token is cheap, they should be buying the token, right? Same with shares. Like
Yeah.
a lot of what Buffett did in his career was just tell his teams when to buy back shares. And that was like a big, probably his major value add as like an activist investor for his teams. Now, like, why do I say that? Because obviously, if you're buying back a token and it's cheap, you're investing at a high rate of return. We think we're investing at 50%. So if Metaplaex can buy back their token, we think they're also investing 50% if we're right about the investment. You don't have full legal protections, right? So that kind of makes it a little more complicated. If a team if we don't really trust a team to invest well or invest well with certainty, we will want them to either pay back the dividend, so we get the cash up front, or buy back and burn, so that if they do the buybacks, they can't go spend it. Like, if a team's throwing parties at ETH Denver, like, we want them to burn the token because they're obviously investing in really low ROI like opportunities. So if it's team based. A team like Metaplaex, which is we think they're really good, really professional. Like they're all kind of ex-TradFi people, or like at least the corporate team is. They're pretty mature. They don't throw big parties, outside of like what's needed for an ecosystem project. And we think that we feel good about them having the capital. So we're happy for them to own the token and then use their judgment to decide how to spend that if they need to in the future. If they start making bad decisions on the token, then our opinion will change.
Yeah.
Right. And that's like another first principle here, where it's like everything depends. A lot of it's like you have to pay attention and make good decisions and update your views as time goes by. Like Banana Gun, when we started working with them, we didn't really know them that well. They're like a non-facing to the outside world. They're a Telegram bot, which has kind of always been seen as like a fringe founder class relative to like, I don't know, like blue-blooded infrastructure, founder podcasts. But the more we've worked, so they pay out dividends. We were fine with that at the time. The more we worked with Daniel from Banana Gun, the more we're like, you should be reinvesting this. Like, we really trust your judgment on how to deploy capital. So like, stop giving it to us and just find a way to reinvest it to grow faster. So again, it's all judgment based. Does that answer your question?
Yeah, I think so, because like, I guess I have, again, having viewed crypto for 3-4 cycles, because the historically so many projects and like so many of these things kind of hit a market saturation point sort of seemingly very quickly, and they make a ton of money, and then the trajectory is mainly downward. If I was to be like investing in your shoes, I think I would lean personally toward wanting them to pay me my money back. And so, I mean, I look at something like Pump.fun, and this is not at all like talking about the founders or anything. I'm looking at purely at the numbers. They built a business now that has made $500 million in, actual money, and they're sending it to Kraken. And I'm sitting here and I'm like, I don't know what they're doing with that, but that seems like, I mean, if they're insta dumping that for USDC, and I don't know, they're paying. I have no idea again how it works, but to me, because we have very little like historical precedent of strong recurring revenue for more than 3 or 4 years, my inclination is like, dude, get as much money out as you can, and like, hell yeah, like burn that. Now that's somewhat of a cynical like take on the sustainability of a lot of things, but I'm definitely not like projecting revenues of Pump.fun to be $500 million for 20 years. You know what I mean? And I think maybe it can be, but I wouldn't just, again, having watched crypto for 7, 8 years, it's like all I can do is go off of what I know, and this is crushing it. I think meme coins have a future, but I don't know you're going to keep making $500 million. So like, I would say, send that to their seed investors. Like, you guys have 3 employees. Great. Like, you're crushing it.
I agree with you, like, strongly. Yeah. You also can't deploy $500 million well, right? Like, you're just going to waste it at some point.
Yeah.
So,
and then the one other thing about buybacks or burns sometimes, and I haven't followed as closely recently, but like I do remember looking at some DeFi protocols in the past that were doing this, and it's like if you're buying back and burning or just buying back a useless token, then who cares? Like, okay, burn it. The chart still goes down. I'm not articulating this well, but it's like, you know what I mean? So sometimes, and I guess that goes to your point, like if you're going to reinvest that in the company, great, but on the other hand, it's like, okay, cool. You're doing some way to, reduce the circulating supply, but if no one gives a shit about the token, then who cares, So that's like been some like observations that I've had, but yeah, I think what you're saying generally makes sense.
But what you're saying makes sense as well, which is like, if you're a project with a 3-year shelf life and you're going to take all your revenues and burn back.
Exactly.
And then it's just going to go to zero. Anything, right?
Cool. Like you made a little Ponzi game, like you made a little intra accounting Ponzi game, like well done.
Yeah. The when it makes sense to buy back and burn when the project is going to actually last for a number of years. So then buying back and burning tokens now just means you get a fatter dividend down the line.
Right.
So that's when it makes sense. And that's why there is some element of this, which is like, I agree with a lot of your takes, most of them, to be honest. But there is one kind of leap of faith that we have as a fund, which I think is important to like acknowledge. We think the industry will eventually S-curve over the next 5 years here. And we've all been kind of like our data set and your data set, and you've referred to a few times, is, fewer than 100,000 users in crypto, playing PvP games, waiting for the Messiah S-curve that never comes. And if that's all it's ever going to be, like our fund thesis is wrong. And you really shouldn't be investing in the industry at all. Like, sure, you can make a little bit of money, but not enough to justify cost of capital.
Yeah, I wouldn't be here doing a podcast and shitposting on Twitter if this stuff didn't fascinate me. And so I am generally optimistic. And actually, that's good time to show your internet financial system and the podcast you did on Bell Curve. Everybody should go listen. It's more along the lines of kind of like the general long-term thesis. And I guess when I brought you on today, I was like, I don't care to talk too much about that because mostly the stuff you say, I agree with. I mean, I think it's very clear that, there are obvious examples where crypto or this industry can make real like improvements to capital efficiency, and stable coins are clearly an unlock. Is it exactly what I care about? Not so much, but it's not lost upon me that it's extremely valuable. And so like none that stuff I'm not going to really debate. And again, the industry growing 100x, like I would probably take your side on that. It's more just where does the value accrete, and like that's where I'm more iffy and I like have, reservations. And I think that's also why I kind of started this by saying like, okay, what we do agree on is that you can build a company and you can make money, and how much you make, maybe that's debatable, but it is possible. Like we've seen it in Web 2. There's no reason to think that'd be different in Web 3. Right. So that's the part I agree with.
Yeah. And the question is, and I think we both agree that there's 90% of companies are overvalued with no moats. So the question is like, are there a few, And that's kind of where the conversation is today.